Hello and welcome. If you've been paying attention to the financial news lately, you know things have been choppy. The word tariff seems to be everywhere, causing ripples and uncertainty in the market. It feels unsettling, right? Stocks go up one day, down the next. It's easy to feel lost or even a bit panicked. But here's a perspective you might not be hearing enough. This kind of volatility, this uncertainty, isn't just chaos. For investors who know where to look and how to react, it can actually create significant opportunities. When fear takes over, assets can get mispriced. Good companies can suddenly look cheap. In today's deep dive, we're going to unpack exactly what's going on based on the insights from the video analysis. We'll look at why this volatility is happening, draw parallels from market history, discuss the impact on consumers and businesses, and then, the part many of you are waiting for, we'll explore the 5 specific stock ideas highlighted, digging into the rationale behind each one: Adobe, the trade desk, AMD, Robinhood, and even a high-octane ETF. Stay tuned, because understanding this landscape could shift how you view the current market. Alright, let's kick things off with a company many of you are probably familiar with, Adobe. You know them, you might even use their products every day. Photoshop, Illustrator, Premiere Pro, the list goes on. These are industry standard tools, and that's no accident. Adobe has a history of innovation and a knack for creating products people love and rely on. Now, around $350 per share, Adobe isn't exactly a cheap stock in the traditional sense, but here's where things get interesting. When we look at the broader market conditions, with all this volatility and fear swirling around, some solid companies are getting caught in the downdraft. Their underlying business might be doing just fine, but the market sentiment can drag their price down. That's where the potential value part of the equation comes in with Adobe. It's a blue-chip company, a leader in its space, and its transition to a subscription model has made its revenue much more predictable. On top of that, they're making serious moves in artificial intelligence, integrating AI across their product suite. This isn't just a gimmick, it has the potential to fundamentally change how creative work gets done. And Adobe is positioning itself to lead that charge. So, you've got a company with a strong track record, a dominant market position, a resilient business model, and a foot firmly planted in the future of AI. When you factor in the potential discount the market might be offering due to short-term jitters, Adobe starts to look like a compelling blend of value and growth. But as always, do your own research, look at their financials, understand the risks, and see if it aligns with your investment goals. Next up, let's talk about a company that might not be a household name like Adobe, but it's playing a critical role in an industry that's undergoing a massive transformation: digital advertising. I'm talking about the trade desk, trading around $48 a share. Now, digital advertising is dominated by giants like Google and Facebook, right? They've got the content platforms, the user data, the whole shebang. So, where does the trade desk fit in? Well, they're not trying to be the next Google or Facebook. Instead, they've positioned themselves as the independent platform that helps advertisers navigate this complex and fragmented digital ad landscape. Think of it this way: you're a big brand, and you want to get your ads in front of the right people across all these different websites, apps, and streaming services. It's a logistical nightmare trying to manage all that yourself. That's where the trade desk comes in. They provide the technology and the tools for advertisers to buy ad space efficiently and effectively, targeting their desired audience across multiple channels. What's particularly impressive is their customer retention rate. Once companies start using the trade desk's platform, they tend to stick around. That speaks volumes about the value they're providing. And unlike some high-growth tech companies, the trade desk is already profitable. They're not just burning cash, they're generating real earnings. In a world where more and more advertising dollars are shifting from traditional media to digital channels, having a leading platform that empowers advertisers is a pretty good place to be. The trade desk is definitely one to keep an eye on. All right, moving on to a company that's at the heart of one of the most exciting and potentially transformative technologies out there, artificial intelligence. We're talking about advanced micro devices, better known as AMD, trading around $90 a share. Now, when it comes to AI chips, the conversation often revolves around NVIDIA. They're the 800-pound gorilla in the room, and for good reason. But here's the thing. AI is a massive space, and there's room for more than one winner. That's where AMD comes in. While NVIDIA has a strong hold on the training side of AI, the part where you're using massive amounts of data to teach AI models, AMD is making serious inroads on the inference side. This is where AI models, once trained, are actually put to work, making predictions, recognizing patterns, you name it. Think about things like self-driving cars, voice assistants, personalized recommendations. They all rely heavily on AI inference, and AMD's chips are becoming increasingly competitive in this space, offering a compelling combination of performance and efficiency. Investing in AMD is, in many ways, a bet on the continued explosion of AI. If AI truly is the next big thing, the demand for these specialized chips is only going to skyrocket. And while NVIDIA might be the current darling, AMD could offer investors a way to tap into that growth at a potentially more attractive valuation. Of course, competition in the semiconductor industry is fierce. It's capital intensive, there are constant technological advancements, and the landscape can shift quickly, but AMD has proven itself to be a resilient competitor, and their focus on AI could position them for exciting growth in the years to come. Now, for a company that's no stranger to making waves, and sometimes even courting controversy, let's talk about Robinhood, trading in the 40s. They burst onto the scene as the democratizing force in investing, making it easier than ever for everyday people to buy and sell stocks, options, even crypto. But Robinhood's ambitions go far beyond just being a stock trading app. They're aiming to become a one-stop shop for all things personal finance, a financial super app, if you will. Think of it like a Swiss Army knife for your money. They want to be the app you use to invest, manage your spending, save for retirement, handle your crypto, and maybe even order pizza with your spare change. Now, the path to becoming a super app is rarely smooth, and Robinhood has faced its fair share of challenges and criticism along the way. But here's an interesting angle: market volatility. The very thing that might scare some investors away could actually play into Robinhood's hands. Think about it. When the market gets choppy, trading activity tends to spike. People are logging into their accounts more frequently, making trades, trying to navigate the ups and downs. And that often translates into increased revenue for Robinhood, especially if they can keep adding more users to their platform. Of course, relying solely on trading fees can be a bit of a roller coaster ride, which is why Robinhood is aggressively expanding its offerings. The more features they add, things like retirement accounts, cash management tools, even debit cards, the more they start to resemble a traditional bank, but with a modern, tech-focused twist. Whether Robinhood can successfully pull off this transformation and become the financial super app they envision remains to be seen, but it's a compelling story, and their ability to potentially benefit from market volatility adds an intriguing layer to the equation. Alright folks, buckle up for this one because we're about to dive into the deep end with a leveraged ETF. The Direction Daily, Russell 2000 Bull 3X shares, ticker symbol URTY. I want to be crystal clear up front, this is not your grandma's investment. This ETF is designed for experienced traders who understand leverage and are comfortable with significant risk. So, what exactly is URT? It's an ETF that aims to deliver 3 times the daily return of the Russell 2000 index. The Russell 2000 tracks small-cap U.S. stocks, which are often considered more volatile than their large-cap counterparts. Now, when you throw 3 times leverage on top of that, you've got yourself a recipe for some wild price swings. Let me break it down. If the Russell 2000 goes up 1% in a day, URTY is designed to go up 3%. Sounds great, right? But here's the catch. If the Russell 2000 goes down 1%, this aims to go down 3%. Leverage magnifies both gains and losses, and that's where things can get hairy, especially in a volatile market. This kind of ETF is not meant to be held for the long term. It's a trading vehicle, plain and simple. It's like a high-performance sports car, incredibly powerful and exciting, but not exactly designed for a leisurely Sunday drive. You need to know what you're doing behind the wheel, and even then, there's always a risk of ending up in a ditch. The analysis suggests that URTY could have significant upside potential, and that's true, but it's crucial to remember that the potential downside is equally significant, if not more so. This is not about picking winners and letting your investments compound over time. This is about trying to time the market, making short-term bets, and understanding that leverage can amplify your losses just as easily as your gains. If you're an experienced trader with a high risk tolerance and you're looking for a way to potentially profit from market volatility, URT might be worth a look. But for the vast majority of investors, it's best to admire this volatility monster from afar and stick to more traditional, long-term investment strategies. So there you have it, a deeper look into the current market volatility, drawing lessons from history, understanding the consumer impact, and exploring the strategic thinking and specific stock ideas presented in the analysis video. The core message remains: volatility creates fear, but it also creates potential opportunity for those who stay informed, focus on quality, and have a long-term perspective. What are your key takeaways? Do any of these specific stocks interest you for further research? Or what's your strategy for navigating these choppy waters? Share your thoughts in the comments below. Let's get a conversation going. If this breakdown was helpful, please hit that like button. It makes a huge difference. And if you want more content like this, analyzing market trends and investment ideas, make sure you subscribe and click the notification bell. Thanks for sticking with me through this deep dive. Remember to do your own research, stay disciplined, and I'll see you in the next video.